Hello my fellow freedom builders and welcome back to the channel. Today we're going to have a look at two dividend paying stocks that might be good value. And I can't say right away that it is normally not two stocks I would consider putting into my portfolio simply because of the trend that is going down right now. But let's have a look at them. I put them in the watch list here saying two value stocks. And as you can see, it is Johnson&Johnson and Target Corporation. Both stocks are stocks I have been asked about in another dividend group on Facebook, so I thought I would take them up. First of all, as we look at just their value here, 27 is fairly low for Johnson&Johnson and Target Corporation is 67. Now, these are historical numbers and looking at some fixed ratios like PE and price to sale and so on. I'll have a look at them in the value chart today to have a look at if they are actually or might be good value. The quality, the earnings are great. We'll have a look at that later. And the momentum, well, there's a bit of a difference here. The overall stock score are fairly similar here. So first of all, if we start to have a look at them just one by one, let's start out with Target here. We can have a look at it in the trading view as well here. Well, looking at this, there's no doubt that the trend is going down. We have a definite lower tops, lower lows and so on. And it has been like that for ages. Had we used some simple trend following logic, we would have been out maybe here when we started to make lower lows. That's around 209.10-ish. Maybe up here when we also made a lower high around 215. And since then, it has basically not been a very good buying case. Now, when we look at the value today, and that is one of the things you should be careful about when looking at value, there is something called a value trap. Because right now we might find out that Target Corporation is great value, but we could also have figured out it was great value here or maybe here, and since then the market has gone down by 30% or something like that. So when you're investing in value, and also, and I know this is why the question came up about good dividend paying stocks, well, Target is paying around 3.5% in dividend. But that doesn't really matter if you all of a sudden need the money and you went in here for a nice dividend and all of a sudden you're down 35% because you will still be forced to sell your stocks. That can be a divorce or a house sale or whatever happens in your life. And that is where the dividend investing can be a bit risky because you might buy into stocks that drops a lot and all of a sudden you need the money. So if you never need the money and just need a steady inflow of dividends, well then Target might be okay if of course they keep paying the dividend. So trend wise it is definitely down, and we can also go in here, we can have a look at the TPI chart here. And if we scroll a bit out, you can also see, well, we would have been sent out at least up here in 160. There was also a lot of selling signals here. And if we go a bit back here, you can see that we got the first warning up here after a very, very long, solid uptrend from, well, basically from the end of the COVID crisis here in April 2020. We got allowed by the model to start looking at this for a long-term trend. So we could have gotten in around 100 and went out somewhere up around in the 200 to 220 area up here. So a doubling of the price, and then it has been somewhat more difficult to get in at some reasonable trend lately. So that is the trend of it. So right now I would be very cautious buying it. But if you think this is just about the right stock, it's the right time, everything, then let's have a look at the valuation of it and see what it says. Well, first of all, let's jump into the summaries. Having a look here, the revenue, well, it went up in 2022 and then it has been fairly stable. The margins have been under pressure. It will be interesting to see if they can come up a bit. And this cut from 8.4 to 3.5 is one of the reasons why the stock has plummeted, definitely. we can see that their operating cash flow went negative. That is definitely not good. And looking down here at the interest coverage, how many times they can pay their interest with their earnings per share, it went from, well, it has been down just below 10, below 7 here, went up massively and then went down again. So all in all, working capital negative, net debt going up and so on. There are a lot of red flags if I should have a look at that. And I'm not sure Target is at the right place right now, but it could be. So let's have a look at it. They have some decent quality numbers here, definitely. And looking at the valuations, we might actually find that there is some potential here. We're going down to 2 years. I know some of you are looking a lot further into the future, but let's just have a look at it and exclude the analyst estimates here. We can see that they are estimated to grow by 27 and 18 over the next couple of years. Let's just make that an average of 23% per year over the next 2 years. Now, if they are at let's just see the latest price earning here. If we're looking at the latest price earning, which was around 28, then this stock actually is set to go up quite a lot. Now, this is very high, so let's take a number that is somewhat more moderate. The average price earning for the last 10 years, well, that is 17.6, meaning that we might actually see a reasonable rise in prices here. Of course, only if the estimates hold through and the business case doesn't deteriorate any further. You could have a look at here back and say this have seemed to be a reasonable area for the stock to be in. A lot of the time it has been around this 60, 70 up to around 100, and it was so from, well, way back in the numbers here from 13 and up towards 19, 6 or 7 years here. Then it started to accelerate very quickly after 2020. Dropped a bit back, and we might be at a more normal level now. So if we actually cut out this area, I know this is not possible, but this is about a bit of an outlier in the data, and you just consider this point to be around here, well, then this might actually be the point from where it can grow. I'm absolutely not certain it will grow 45%. This is a purely theoretical speculation. But we can see that, let's say, for instance, they only grow by 20% per year over the next couple of years, or maybe even bump it down to 17. Well, they will still go up by 8 or 9% per year over the coming years, even though the stock will be in a bit of a less stellar movement upwards here. And this is only with a PE of 15, meaning that we are actually taking a PE that is lower than anything it has been, any average it has had over the last many years. So Target, well, at a point right now where I would say, nah, I'll doubt it a bit. The trend might be a bit too steep down. But again, if you want to be in for the long term, let's say they could actually keep up a 15% growth in earnings per share over the next, let's say, 3 years, 4 years, or 5 years, you will actually see a yield here of your money of around 12% per year. And this is, again, only with a PE of 15 and a growth in earnings in 15. This might even be bumped down lower to, let's say, 10%. This is actually just, well, without compounding, around 50% over the next 5 years. That is actually almost what is expected just over the next 2 years. And then let's have the average price earning that we have seen over the last 20 years. Well, we are seeing some very steady growth. And if you can settle for 8 to 10% per year, and you're willing to hold Target and believe in the future of the chain of stores, well, then Target might just be a reasonable setup. Personally, I will probably wait for a bit of consolidation, not necessarily an uptrend if I wanted to get into a value stock, but just some sort of consolidation showing that the insane dropping knife here is not just keeping or staying on this trajectory down, but actually stabilizing a bit and starting to show a bit of stability. All right, next one is JNJ, Johnson & Johnson. Here. Now, this is not the same long trend down as you saw with Target. This is more of a, you could say, a steady mess. We could draw in some trend line, one here. Whoa, let me try that again. One here, and copy it down to here, and say that, yeah, well, it has been moving for the last couple of years between 150 and 180. And the question is, can it move itself out of this? Now, it has gone up for a number of years here, and Johnson & Johnson has been a fantastic investment, as you can see here. Well, it just keeps, basically no matter how far you go back. It has gone from 30 down here in 08 and up to, well, 180 here, so a 6x, which is amazing. Now it has spent a couple of years just going sideways, and this can be okay if you are a long-term value investor, because if they are still producing a profit and an increasing profit, well, then a sideways price movement just builds up some internal value in the company. So let's have a look at, we can actually just choose it from the watch list here. Let's have a look at it over here. First of all, nothing really trendy here, and you could say if you're looking for a trend, it's actually turning down here. So again, I personally might just wait a second to see, will it stabilize a bit, but you could easily argue that this is the right point to go in. If you accept that it might go down 5% more or something like that, but also accepting or realizing that if it all of a sudden starts to move up, well, then you are in the stock right from the bottom here. So let's have a look at it. First of all, the TPI chart, it has been a bit mixed, and I talked about that in the last video. If you are a trend follower, then these movements here are not very nice, because you just get an uptrend. I know we wouldn't buy it just on the long uptrend, but let's just say we did. You would get a buy signal here, then a sell signal, then it would start to go up, and you would get a buy signal here, it would drop, and you would get a sell signal, and you get the point. These sideways violent moves here are terrible for trend followers like us. So at this point, it could have been a better investment just being a value investor and adding to the position once in a while and just getting a reasonable average price. But let's have a look at the summary, just to look at the Johnson & Johnson here. We can see they have a reasonable PE ratio actually at 17. You're getting a reasonable yield of, what, 6% or something like that just from the PE ratio. That is 100 divided by 17. The PEG ratio, where you take the price earning divided by the expected future growth, is actually very low. I normally want to have that around 2, maybe lower, and this is 0.5, meaning you're not paying too much for future growth, and we can see that the expected earnings per share growth is almost 60%. We're looking at the numbers down here, return on capital, equity, and the margins are actually very fine. We can see there have been an adjustment upwards in the estimates for 24 and 25. Looking at the revenue, that is going up fairly well, with a higher percentage in the upcoming years, and looking at the target. And looking at the earnings per share, we are seeing some very nice moves upwards as well. It has been stable for a year, for some years, going up in 21, dropping a bit in 22, but now it seems like it is on the right path again. We have some reasonable good free cash flows here. And looking at the numbers, cash is okay, some negative working capital. We can see that the interest coverage, how many times they can pay over their interest rate, is very high. So they are absolutely not over leveraged, and they are not hit too hard by the higher interest rates. So let's go into the valuation chart here, and again start looking at 2 years. The average growth over the next couple of years is something like 30% per year, maybe a bit higher, but let's put it in the low end. And let's have the latest price earning just to see what that would do to the price. That would actually indicate, and don't worry, I'm not saying this will happen to Johnson & Johnson, but if they are growing their earnings per share by 30% over the next couple of years, per year of course, and they are staying at a 26 in price earning, then the price will be 90% higher when we exit 2024. That is actually a reasonable place to start. So let's say the estimates are not holding through, and I like to find stocks where we could say, okay, the estimates are actually looking good. However, let's try and make it a bit worse to see what is the worst case here. So let's say they only grew by 20% per year over the next 2 years. We would still have a very nice profit here. What if it went down to 15%? Still a nice profit. What if we went down? Well, we are actually down at the lowest point. You should realize that these two are not the analyst estimates. That is the price earning. If we stay at the current price and the future earnings per share estimates are holding through, then they will be 17 and 16.1. So these are not really something that we believe in. I believe more in the latest here, maybe in the 3-year average or the 5-year average, and we can try to bump it down even further to, let's say, 22. We would still have a fantastic business case here. What about 21? Still 20, still a very good business case with 13% over the next bit less than a year and a half. So when I'm looking at Johnson & Johnson, I'm actually looking at a way better value case than if I look at a Target. So should I choose between the two of them, I would definitely choose Johnson & Johnson. But I know many of you out there that are looking at a bit longer term value are actually choosing both of them. The Johnson & Johnson is paying around 3% dividend. And we can try and bump this up and say, what if they could continue this sort of growth over the next 5 years? Well, then you would be sitting on 13% per year, even at a fairly low price earning. If it went up to its average over the next 3 years, well, you would be sitting on almost 20% per year on Johnson & Johnson. So I do believe the value investors that say to themselves, well, Johnson & Johnson, they have actually been generating money for the last couple of years with the stock just going sideways. So why not buy into that internal value right now and expecting some more growth? I am looking at Johnson & Johnson myself for my longer term portfolio. Target is also on the watch list, and what you do with your money is entirely up to yourself. This is not financial advice. I'm just trying to show you how we use the MyStockScanner to see if we can find some reasonable, good long-term investment options. Also, we can go down to a shorter term time frame and say, I'm not buying this until it starts to be a bit green here on the long-term time frame. Maybe find some triple greens or the other swing trading setups we have, and then go for them even though you're a long-term investor. That's all for now. I hope this was helpful. And as always, you're welcome to write me either in the comment section under the YouTube video or on Facebook or wherever you find me. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.